Many individuals perceive compounding as merely a straightforward idea. Your initial investment generates returns, and those returns are reinvested to enhance your overall growth. In practice, there are 4 distinct methods or stages through which compounding can benefit you as an investor, and many individuals are missing out on potential gains by relying solely on one of these approaches. To effectively enhance your financial growth, it's essential to grasp all 4 elements, as their combined impact can significantly transform your financial future. Stay with me until the end, as understanding the interplay of these strategies will reveal the true potential of compounding. Let's start with a strategy that is often discussed among investors but is seldom utilized to its maximum advantage: dividend reinvestment. When a stock or fund distributes dividends, you typically face 2 options. You can either receive the cash and allow it to remain unutilized, or you can reinvest it into the same investment that generated the payout. Reinvestment, frequently executed automatically via a DRIP program, may appear to be a minor action, yet it initiates a compounding effect that expands significantly over time. Every dividend you receive allows you to acquire additional shares, which in turn produce their own dividends, creating a continuous cycle of growth. Over extended durations, this process consistently and gradually enhances your financial growth. One of the most advantageous aspects of enabling dividend reinvestment is that it alleviates the need for continuous market monitoring or decision-making with each cash inflow. The system manages everything on your behalf. All that is required from you is a bit of patience. Consider beginning with a $100,000 portfolio diversified among robust dividend-paying stocks. Rather than withdrawing quarterly or monthly payments, you allow every dollar to be reinvested for future growth. While the difference may appear modest over a decade, extending that period to 20 or 30 years reveals a significant disparity between individuals who reinvest dividends and those who do not. Research indicates that reinvested dividends have played a significant role, accounting for almost 1/3 of total market returns over the decades within the S&P 500. In essence, without this straightforward feature, you are effectively sidelining a significant portion of the market's potential for long-term wealth generation. However, relying solely on dividend reinvestment may not suffice. The second type of compounding that frequently goes overlooked is the effect of time in the market. While it may seem straightforward, maintaining your investment strategy is one of the most overlooked methods for building wealth effectively. Well, if you're not subscribed to our channel yet, you might miss major financial concepts, so please do that and also press the like button. Individuals who frequently shift their investments, aiming to pinpoint the ideal moment to buy or evade losses, frequently overlook some of the market's most lucrative days. Missing even a handful of those days can significantly impact your long-term returns. Staying invested allows the power of compounding to work in your favor over time. Investing in a quality business or a diversified index fund has the potential to significantly increase in value over time, provided you maintain your investment and avoid the urge to liquidate prematurely. Consider organizations such as Apple or Microsoft. Individuals who made investments years ago and maintained their positions not only benefited from consistent returns but also witnessed remarkable growth over time. Apple has achieved average annual returns nearing 30% over the past 2 decades, with the majority of that success stemming from the power of compounding and consistent business growth, rather than relying on short-term trading strategies. The passage of time amplifies all aspects of investing. In the initial 5 to 10 years, the growth may appear to be modest. However, as the years accumulate, the outcomes become truly remarkable. With a consistent investment strategy, your portfolio has the potential to grow significantly over time, transforming from thousands to millions with minimal additional effort. What should you consider if your initial investment is limited? This is where the third type of compounding plays a crucial role, making monthly contributions. This concept is rooted in the strategy of dollar cost averaging. Rather than holding out for an ideal opportunity or accumulating a large sum, you choose to allocate a consistent amount each month for investment. This strategy benefits you for two key reasons. Initially, it eliminates emotional factors. There's no need to question if the market is currently overvalued or undervalued. Secondly, this approach allows you to acquire more shares when prices are low and fewer shares when prices are high, effectively reducing your average cost per share over time. Even modest monthly contributions, when combined with compounding, can grow significantly over time, leading to substantial financial benefits. Consider the impact of contributing $500 or $1,000 each month to an investment over a 30-year period. While that figure may be manageable for numerous households, the potential for growth is truly remarkable. Over the years, your total contributions could accumulate to a few $100,000, but the power of compounding might elevate that amount to several million, particularly if those investments are allocated to dividend growth companies or broad market index funds. What may appear modest at first can develop into a powerful surge of expansion. The fourth and final form of compounding we should consider is dividend growth. Numerous investors pursue the highest dividend yields available, believing that increased income today translates to greater wealth in the future. The true advantage is found in companies that consistently increase their dividends annually. When a company consistently raises its payout by 7% or 10% each year, it may seem unremarkable initially. However, over the course of a decade or two, those dividends can significantly compound, resulting in a substantial and growing income stream. The compounding effect of dividend growth is exceptionally potent, as it provides you with dual advantages simultaneously. The value of your portfolio increases as the companies within it grow, and concurrently, your income increases without the need for additional contributions or reinvestment. Indeed, a portfolio centered on dividend growth companies has the potential to generate substantial annual income streams, reaching six figures, solely from increasing payouts. These increases, when compounded over time, serve as a safeguard against inflation. As the cost of living increases, you can expect your dividend checks to grow as well, providing you with enhanced financial stability and flexibility during retirement. By integrating these four compounding strategies, dividend reinvestment, time in the market, monthly contributions, and dividend growth, you establish a robust financial engine that surpasses the individual benefits of each component. Individually, each possesses significant strength. Collectively, they enhance your financial growth at a rate that exceeds the expectations of many. With a starting portfolio of $100,000, combined with reinvestment, consistent contributions, and a sufficient time horizon, the potential exists to grow this amount into several $million. Utilizing tax-advantaged accounts such as Roth IRA or TFSA allows you to retain a greater portion of your investment growth, minimizing your tax liabilities. If you have relied solely on one method of compounding thus far, you may be at a significant disadvantage in your financial strategy. Affluent individuals understand the importance of diversifying their approaches. They implement multiple strategies and allow time to work in their favor. You can achieve that as well. If you are committed to building sustainable wealth over time, it's essential to explore multiple avenues of compounding. Implement all four strategies simultaneously, maintain consistency, and allow sufficient time for them to yield results. Now, watch the video appearing on the left side to know why your wealth skyrockets after hitting $100,000. Also, subscribe to our channel to help us complete our goal of 10,000 subscribers.